In the world of investments, there's an old saying that applies just as much to the stock market as it does to anything else. If it sounds too good to be true, it probably is. When it comes to dividend-paying stocks, this principle holds strong. If you encounter an investment offering a yield far above the norm, you need to proceed with caution. Why? Because you may be walking straight into a dividend trap, the allure of high yields. When you see an advertisement for an investment boasting a dividend yield of 10%, 15%, or even 20%, it's hard not to get excited. It sounds like a golden opportunity. Who wouldn't want to get that kind of return? But this can be a dangerous game. A good investment typically provides steady, sustainable returns, not a flashy, unsustainable yield. Example 1. The dangerous appeal of small-cap stocks. Take a look at a small-cap stock in the tech sector that claims to pay a 20% dividend. At first glance, the high yield might make you think, this is a winner. However, what's usually hidden behind such an offering is the company's financial instability. Small-cap stocks can be volatile, and they often struggle with cash flow issues. In this case, the company may be paying out more than it can afford, dipping into its reserves or taking on additional debt to cover the dividend payments. When the market hits a rough patch, the company's stock could plummet as investors flee, and suddenly, that once high dividend becomes unsustainable. Before you know it, the dividend is slashed and the stock loses value. What appeared to be a fantastic opportunity is now a painful lesson in high-risk investing. Example 2. The real estate fund with sky-high returns. Real estate funds can also fall into this category. Imagine a fund that promises an annual 18% return from a portfolio of rental properties. The returns are being driven not just by rent payments, but by speculative bets on property appreciation in a specific area. When investors hear about huge yields, they tend to forget that real estate markets can be cyclical and unpredictable. If the market cools down or property values dip, those massive returns can quickly evaporate. Worse, if the fund is leveraged, meaning it borrowed money to make investments, the risk increases. As the value of the properties falls, the debt remains, potentially leading to a reduction or halt in dividend payments, leaving investors holding the bag. What's the real danger? The issue with these investments isn't that they can't work out in the short term, but that they come with huge risks. High-yield investments often seem attractive because they promise quick, large returns, but they're often a sign of greater underlying instability. The reality is, most of these high-yield offerings are not backed by solid financial fundamentals. They could be risky business ventures, highly leveraged assets, or companies struggling to maintain consistent earnings. When the economic environment shifts or the company faces a downturn, those dividends disappear and the stock price might follow. The key to smart investing: sustainable, steady returns. The lesson here is simple. Don't be seduced by the bright lights. It's easy to chase after high yields, but true wealth building comes from long-term, steady investments. The most reliable assets are those that provide consistent, reliable returns over time, even if the yield is lower. Think about large, established companies like Johnson & Johnson or Coca-Cola, which have been paying dividends for decades. Their yields might not be sky-high, but their financial stability and steady performance make them much less risky than those too-good-to-be-true opportunities. These kinds of investments are the foundation of a healthy portfolio, not the high-flying speculative assets that promise quick riches. Final thoughts. Know when to walk away. As an investor, your goal should be to create a balanced portfolio that can weather market ups and downs. If you're tempted by a high-yield opportunity, make sure to dig deeper into the company's fundamentals. Research the business model, understand the risks involved, and ask yourself whether the returns are truly sustainable. If the high yield is the only thing that stands out about the investment, it's time to walk away. If you're looking for high returns, focus on real, sustainable growth, not just the immediate allure of large dividends. In the end, the safest bet is often to stick with stable, steady investments that might not promise instant wealth, but will steadily build your wealth over time.